All right, let's look at this fifth one. This is a lot like the last one. We're going to look at two conditions. One where it's more likely than not that we will be able to take advantage of this deferred tax asset, and then the second one is going to change that condition. First off, the fact set for this one and question 4 are very similar. It's a deferred tax asset. It has a balance of 30 million in it, attributable to a book-to-tax difference of 75. At the end of year 2, this book-to-tax difference is estimated to be 88 million. It has a valuation allowance of 10 million. All right. Now, they want us to do the condition of asset will be realized. If only they said it like this, that'd be so much better, right? What that means is that I need to recognize what the asset needs to be at the end of the year, but also recognize that this $10 million valuation allowance doesn't need to exist, because that's only existing because we're treating it like it's an impaired asset, and now we're saying, no, it's not. All right, so let's go to do the first part. This is the deferred tax asset. It was at 30, and then we need to figure out where it needs to be, and they said that the book-to-tax difference is estimated to be 88 million, and our tax rate is 25%. That gives us 22. That's what it needs to be, and here's my adjustment right there. Adjustment is for 8. Credit side. Now I can do my journal entry, and my journal entry is just going to be tax expense, which I don't know yet. And then we have deferred tax asset. Is for 8, and then taxes payable, which we know because it's 180 million times 20%, 25%. Okay, so 180 is 45, and what that gives me is tax expense equal to 53. All right. Now, the other thing that I had to do here also is back out this valuation allowance. I just need to do the opposite from the way that I did it, which means just debit the valuation allowance, and let's just do it in a different color. So valuation allowance. This is me getting rid of it for 10 million, and then income or tax expense is 10 million. All right, so added that flare to it. Now what we're going to do is we're going to say to ourselves the second condition, which says that prepare the journal entry to record Pearl's income taxes for year 2, assuming that it's more likely than not that 1/2 of it will ultimately be realized. So they're saying that 1/2 of this deferred tax asset will be realized. All right, so 1/2 of the asset will be realized, and let's go and figure out what that asset's going to be worth. This is my DTA. It started out as a balance of 30 and ended off as a balance of 22. Remember, we took the 88 times 0.25, and that showed our adjustment. However, this is the value of the deferred tax asset, of which only 1/2 of it's going to be realized. So when I come here and I say that, what that means is that the deferred tax asset should equal 11, and that will be the amount that I need to adjust by. And so this valuation allowance is needing to be 11, and so when I come here and go to the valuation allowance, the deferred tax asset is going to equal 22. the allowance needs to equal 11. And that's going to be credit side. And where the balance is now is at 10. All right, and so the adjustment needs to be 1, and it needs to be an increase of 1 to the valuation allowance. So we're going to say tax expense is 1, and then valuation allowance 1. Okay, alrighty, that'll do that problem. We'll do the rest of them later.